Good morning, good afternoon, and good evening. My name is Diana Barrero-Zales, and I am the Global Blockchain Business Council's Head of Research and Sustainability. It is my pleasure today to welcome you to GBBC's Virtual Members Forum on how tax reporting requirements are changing the way we think of digital asset compliance. This is a bi-weekly webinar showcasing the innovative work of our members around the world. And today we are joined by John Schoenecker, Head of Policy at Taxbit. GBBC member Taxbit is an end-to-end compliance and reporting solution for the digital economy. Taxbit's single API-powered platform for tax and accounting reduces manual work, improves operational efficiency, and more. Briefly, before we begin, I'd like to introduce John also. And John Schoenecker, as we said, Head of Policy at Taxbit, works as with a leading SaaS provider to enterprise and governments, helping them manage information involving digital assets for tax and accounting purposes. He joined Taxbit in April of 2022, bringing with him a background in tax policy, investigations, and litigation. Before that, John was a senior investigative counsel for Senator Charles Grassley on the U.S. Senate Committee on Finance, where he led the committee's 2020 bipartisan investigation into syndicated conservation easement transactions and was the primary author of that investigation's report. Prior to that, he was counsel to U.S. House Ways and Means Committee Chairman Kevin Brady during the 2017 tax reform effort. From 2007 to 2015, John was a trial attorney for the U.S. Department of Justice's Tax Division, where he litigated high-profile shelter cases, most notably the STARS foreign tax credit generator transaction. He has been a contributor to a leading U.S. tax publication and guest lecturer on the taxation of digital assets. And John graduated from Northwestern University's Law School and the Medill School of Journalism as an undergraduate. Thank you, John, for joining us. We welcome the audience's questions at any point during today's presentation. Please submit them in the Q&A tab at the bottom of your Zoom screen, and we will take them after the presentation. John, I will now hand things over to you to begin.
Thank you very much, Dinah, and thank you all for joining us today. I appreciate you taking the time to talk with me and to talk about taxes and tax reporting in this space. It's a growing area, and it's going to become increasingly more part of everybody's focus next year and the out years throughout the rest of this decade. So thank you very much. As Diana mentioned, I'm a former tax staffer for the U.S. Congress. I was there in 2017 when the United States Congress passed the last big tax bill, which it's going to do again next year coming up. So it's going to be a really interesting time in the United States for taxes, including in the digital asset space, as it already is for tax reporting, which we're going to talk about today. One bit of disappointment that I'll share with you is that I am doing this solo. My colleague, Max Bernt, who is in certain respects my counterpart in Europe, he's our managing director in Europe, is unable to join us today because he's frankly on a flight that was dramatically delayed. So I apologize for that. That's me. I'm the head of policy at Taxbit, and that's my colleague, Dr. Max Bernt, again, managing director for Taxbit in Europe. Obviously, he won't be on the call today, but if you don't already know Max, and you're in, especially if you're in Europe, I strongly recommend getting to know him. He is a wonderful colleague to have, and he is a terrific person to get to know, and I encourage all of you to get to know him, and I'd like to get to know you as well. So today, let's talk about global tax information reporting. And before I get started in earnest, I will make a pitch to everybody who may not have heard this pitch before, which is tax is more interesting than you think it is. Most of the time when people hear tax, they're like, oh God, I have to talk about that. I really don't want to have to talk about it. How long is this meeting going to go for? Tax information reporting is obviously not a profit center. It's a compliance issue, and we are more than happy to help you work through it But talking tax is fun. If anybody wants to talk tax with me afterwards, I'm happy to do that with you. But for now, let's talk about global tax information reporting. And let's start with CARF. CARF is an acronym that you probably heard about in the last couple of years. It stands for Crypto Asset Reporting Framework. It is the framework adopted by the OECD about 2 years ago, covering how jurisdictions throughout the world should do tax information reporting to basically close tax gaps throughout the world with regard to digital assets. This is an area that governments throughout the world are still trying to get their heads around. In the United States and other countries as well, we're just on the cutting edge of this. And this is frankly your chance to be involved in those discussions as to how individual countries do tax reporting, because they're still trying to kind of perfect it. CARF is the framework they use for implementing at the local level outside the United States. But when it comes to best practices and how to do it, this is still your chance to get in at the ground level and say, this way is better than this way, and we can help you do that because that's our business. Under CARF, let's talk technicalities. Under CARF, what entities have to do reporting under CARF? What assets are included? What types of transactions are included in that? Let's start with entities. CARF uses the term CASP and sometimes RCASP. RCASP just stands for Reporting Crypto Asset Service Provider, which is basically any exchange or any entity that brings buyers and sellers and traders of digital assets together, which beget what are usually taxable events. If any entity falls under that category, chances are they are an RCASP or a CASP. That covers what crypto assets does that cover? Going down to the next row there, payment tokens. CARF refers to basic traditional cryptocurrencies like Bitcoin and Ether as payment tokens. It also includes what we commonly refer to as stable coins, what they refer to as asset reference tokens, as reportable entities sometimes, and this is a bigger discussion perhaps for afterwards, sometimes those fall into a previous incarnation of reporting in Europe known as DAC 7. We'll talk a little bit about DAC 8, which applies to digital assets, which is really the application in the European Union of CARF. But either way, stable coins are covered one way or another. Crypto assets also include debt and equity tokens, basically classic traditional finance debt and equity that is tokenized. That's the same way as in the United States, as well as certain NFTs. CARF covers and requires the reporting of basically NFTs that are financial in nature. And that's something that doesn't kind of beget a real clear line. In the United States, the Department of Treasury wrestled with that too. Do we require NFTs to report or not? Sometimes they're financial instruments that people use for investment purposes, and sometimes they're just fun things to own, which aren't quite as financial in nature. Basically, CARF says to jurisdictions, to the extent NFTs are financial in nature, they are covered assets that are part of tax reporting. And what transactions of these crypto assets are covered under tax reporting? First and perhaps most obviously, exchanges between reportable crypto assets and fiat currency, buying and selling cryptocurrency with cash, exchanges between one or more reportable assets going from asset to asset, trading. That's also generally a taxable event. It certainly is in the United States and is generally a reportable transaction in other jurisdictions. It also requires, and we can go into greater depth on this if you want to, transfers of reportable crypto assets between wallets, such as going from an exchange or a hosted platform to a cold wallet. This is sort of a new thing when it comes to the world of tax reporting. It's a very centralized part of our ecosystem. But to the extent jurisdictions are trying to figure out how to deal with this in a traditional finance framework when it comes to tax reporting, that's kind of a tough one because it's not, I don't want to say it's not common, but it's not a big part of the traditional finance ecosystem. Usually when you hold assets on your brokerage account or something, you leave them there and you don't transfer them. You can transfer them and you do transfer them, but it's not something you routinely do probably. Well, in this ecosystem, you do. And that is central to exchange of information for tax purposes, because you got to know where stuff is coming from and where it's going to and what its cost basis was and what the proceeds are from that. And so that's something that jurisdictions are wrestling with. And that's something that's going to be handled at the reporting levels in the years to come throughout this decade. And finally, under CARF, high value retail payment transactions, where you're buying a good or service for more than 50,000 US dollars worth of digital assets, that's reportable. That's actually a pretty high threshold compared to what the United States is doing. The United States generally requires reporting of all transactions with certain thresholds for types of assets used, or in certain situations, whether the broker fits into a certain category or not. But for the most part, all transactions in the United States are reportable, and I'll get to that a little later. Moving on, how does CARF work? What does CARF require you, if you're an RCAS, to do? And this is generally the same sort of thing that's going to happen throughout the world, whether it's CARF or the United States. And one of the first things you have to do is basically know who your customers are. KYC, as we like to call it in the United States, and probably in other jurisdictions as well. You generally have to know what the name of the person is, the name of your customer, where that person is sitting, and what that person's tax identification number, what we most commonly know in the United States is a social security number. What is that person's tax identification number, so that you can do tax information reporting on that entity? Once you have that information in place, and this is something I will say we can help you with, once you have that information in place under CARF, what you're generally going to be doing is annual reporting on an aggregate basis by type of crypto asset, distinguishing between outward and inward transactions, whether a remittance is coming into the customer in the country or going out to another country, as well as making a distinction between crypto to crypto and crypto to fiat transactions. Going down to the third bullet point, these transactions for CARF purposes are to be reported on an aggregate basis with number of transferred units and reportable transactions to be reported, and types of transactions where known also have to be divided up. Is something an airdrop, or is it income from staking or lending, or is it something similar to that? That's the report. That's the sort of thing that needs to be broken down, even though aggregated. A central focus to this is tax authorities in one jurisdiction eventually, really by 2028, sharing information with partner jurisdictions. The idea being, I am sitting in jurisdiction A, but I know that I have a customer who is in jurisdiction B. So I'm going to be collecting that information, providing that information to my authorities in jurisdiction A. And then the authorities in jurisdiction A share that information with the authorities in jurisdiction B. That's not happening yet. It's not happening yet in the United States, but by the end of the decade, that's the idea. And that's really building on the automatic exchange of information protocols that have been happening outside the digital asset world, really for the last 10 years in traditional finance and traditional banking and the like. And what CARF is doing is applying tax reporting for digital assets to that regime, generally to normalize it. The purpose, perhaps obviously, is for tax authorities to identify tax non-compliance so that they can enforce their tax laws within their jurisdiction. CARF is really a risk assessment tool designed to figure out where the biggest areas of non-compliance are, so that they can go further into saying, okay, this person, and this person. We need more information on this person, and this person, because we think that's the biggest area of non-compliance. And this is really going to be part of kind of, and there's, obviously there's some pushback to this, obviously, but normalizing the sector, bringing it into compliance with other traditional finance areas that have been doing this for several years now. For CARF, what is the first deadline to care about? On January 21st, the idea is that our CASPs, crypto asset service providers, will be collecting information on their customers as of January 1st, 2026, so that they can report that year's information to their local jurisdictions in 2027. In the last year or so, all the OECD nations and several other, all the European Union nations and several other OECD nations signed on agreeing to implement CARF in their local laws by the end of December next year in 2025. So it's going to happen, but there's still time to kind of get your heads around it, work within your own systems to get it up and running, and that sort of thing. Moving along. In the European Union, when you hear the term DAC 8, DAC 8, which is really the seventh amendment to the automatic exchange information protocols that I was talking about before, DAC 8 is the application of CARF within the European Union. It transposes CARF into EU law, requires reporting on EU client transactions, regardless of place of business. Again, the idea is that if you're servicing a EU customer, someone sitting in an EU jurisdiction, and you're not an EU jurisdiction, eventually you will be reporting to your local authorities, who will then report to that respective EU jurisdiction on what this person does. And obviously, this is aimed at combating tax evasion and fraud within this ecosystem, just like this regime has been doing in the traditional finance sector for about 10 years now. Who does it affect? Obviously, it affects crypto exchanges, custodians, and wallet providers. And what sorts of information do they have to provide? As I mentioned before, the three key ones, things that you have to know about everybody eventually, are name, address, and the person's tax identification number. What sorts of information about their transactions will have to be reported on, numbers of transactions, asset types, and balances of accounts for information for customers, as well as dates, types, and values of transactions when it comes to the details of those transactions. Let me get to my wheelhouse here, which is US tax reporting. I have basically done nothing but think about this for the last 2.5 years. Generally think about the United States as being 1 year before the rest of the world. As I mentioned before, OECD jurisdictions, EU jurisdictions, to the extent they adopt CARF on time, they will, CASPs in those jurisdictions will generally have to start tracking what their customers do as of January 1st, 2026. In the United States, certain brokers, as we call them, will have to start doing that this coming January 1st in 2025, so that they can do the very first tax reporting, what we call Form 1099, tax reporting in early 2026. We're 1 year ahead of everybody else. So we're kind of, the analogy we say here, we're the canary in the coal mine. We're the ones going first to figure out what to do and how to do it. Just a little timeline for you. One of the questions that may be coming is, are jurisdictions on time? And I kind of chuckled when I saw that question because, well, depending on your perspective, yes, they're on time, but the United States is actually 2 years behind what it was supposed to do. This is a requirement that the US Congress put into effect 3 years ago now, in 2021, saying, all right, all you brokers of digital assets, start collecting your customers' information in 2023 so that you can report it in 2024. The US Treasury Department, right before that was supposed to happen, put out a notice saying, we haven't put out regulations specifically saying how to do this yet, so don't do anything until we put out final regulations on that. Well, when did that happen? Excuse me, in August of last year, in 2023, they put out proposed regulations on how to do this, and some of you might have commented on that. They didn't put out the first batch of final regulations until late June of this year, specifically saying, okay, now in 2025, brokers of digital assets start reporting or start collecting information so that in 2026, you can start reporting on those. And what is required in the United States by US brokers of US taxpayers is digital asset gross proceeds, not cost basis, but gross proceeds. Gross proceeds, if you don't know, is just, hey, Max, how are you? Gross proceeds is just a tax way of saying, what did someone get for selling digital assets. What was their proceeds amount? Cost basis is what did they originally pay for those assets in the first place? And that's reporting that will eventually come, but a year later in 2027. Additionally, in 2026, and I'll get into a little more details of this in a second, customers will have, or brokers in the United States will have to know who their customers are with greater specificity as time goes on. By 2027, US brokers serving US customers will have to have certified knowledge of what their tax information numbers are, what their social security numbers are. We can get into that in a second. The big thing in the United States, the big debate at the legislative and administrative level is who is a broker in the first place. There's not much debate that what we generally refer to as centralized exchanges, entities that take your fiat money and give you an account on the platform, know who you are, and let you use that account to buy and sell digital assets, are brokers under US law. What has always been more controversial is, do protocols that don't do that don't take your cash, that aren't known as on and off ramps, are those brokers? And in proposed regulations and in final regulations, the US Treasury Department has said, yes, what you guys call DeFi, decentralized finance, your broker's under the law too, and you will have to do tax reporting, but not yet. And the first batch of final regulations saying how to do tax reporting in the United States, which came out this past summer, only apply to what's known as custodial brokers, brokers that in some way, shape, or form take private keys from users and hold them in some way, shape, or form. What does that specifically mean? That means, quote, to quote from the US regulations, digital asset industry participants that custody the private keys for digital assets being sold by their customers, such as operators of custodial digital asset trading platforms, digital asset hosted wallet providers, processors of digital asset payments, what we call a PDAP. If you hear the phrase PDAP, that's what that means. And persons that accept digital assets as payments for real estate, and issuers of digital assets that offer to redeem those digital assets are covered by the first batch. The last category there basically means stablecoin issuers, and we can talk about that more too if you like. So again, DeFi, decentralized entities that don't hold private keys for users, are not covered yet. Treasury officials have publicly stated that they want to get final regulations out by the end of this year on how DeFi will have to report. So we're fairly certain they're going to have to report. It's a virtual certainty, but not yet. And almost certainly not, they will not have to start tracking their customers' assets, their customers' trades in 2025. Moving along, again, it starts.
John, maybe I can jump in quickly. Actually, I joined. I'm very, very sorry, everyone, that I joined so late. I just arrived at the airport. My flight was 3.5 hours delayed. So just to add to the discussion that John just mentioned, because I mean, the topic of decentralized finance being reportable under 1099-DA and also under the crypto asset reporting framework is a very hot topic at the moment. And basically what we are seeing is that also the US delegations at Working Party 10 were really the ones that were pushing for clarification of this issue on the level of the OECD. So just recently, the OECD issued its FAQs for the implementation of the crypto asset reporting framework. And thereunder, at first they had included non-custodial exchanges, including decentralized exchanges being reportable under the crypto asset reporting framework. Then when they finally issued the FAQs, they took out the wording decentralized exchanges. So right now, only non-custodial exchanges are covered. But then again, the OECD is currently working on more comprehensive FAQ, answering this question and basically drawing from the definitions of the Bank of International Settlement that really divided decentralized finance into 3 distinct layers, namely settlement layer, application layer, and interface layer. And then the question, which of these layers would be required to report on the crypto asset reporting framework? Just wanted to quickly add that here because I think also from the side of the US, when we will see a consensus on this on the level of the OECD, this will also trickle down to the United States. Thanks, John.
Yes, absolutely. And thanks. I'm thrilled that you got to join us, Max. Thank you so much. Getting back to the United States, as Treasury often does, as the U.S. Treasury Department often does, they provided transition relief, helping you go from not having to do anything to having to comply. And so that there are as few hiccups as possible in people trying to comply, but mistakes will be made. And the two big ones are some things I want to go over for you. Penalty waivers in 2025 under the U.S. tax code, and this has been in place for years. There are different levels of penalty per Form 1099 that have mistakes on it. There are a couple dollars, and depending on how grievous the mistake is, the penalties get higher. Obviously, if you make a mistake, you're making a mistake at the level of thousands or millions, not one or two. So penalties can be pretty stiff. What the U.S. Treasury Department has said, and they made this official. Okay, for all brokers that have to do reporting, if you make a good faith effort to comply for tax year 2025 on time, we will waive all penalties. If you don't bother complying, penalties apply. But if you make a good faith effort to comply and make mistakes in doing so, penalties are waived. So what I tell other people is to think of 2025 as what the theater community would call a dress rehearsal. This is your time to try your best, try to perform as well as you can. And if mistakes are made here and there, it's fine. Learn from those mistakes and move on. The second big thing, and this is a big deal, is that backup withholding is not required in 2025. And this is getting a little technical taxish. What this means is in U.S. tax code, for any entity that has to do tax reporting on a customer who does not have a certified tax identification for that customer can still service that customer. But they don't get out from reporting on that customer because they don't have their social security number. What they have to do instead is they basically say to the customer, well, you're not telling us your social security number, so we're going to withhold 24% of the proceeds that you made on this transaction and pay it to the IRS, pay it to the Internal Revenue Service, and then you can deal with that on your own tax return. We paid it for you already because we couldn't do tax reporting on you. Well, one of the biggest logistical lifts that brokers in this space will have to do, especially with their existing customers who may not have provided them with a certified tax identification number, is say to them when they log in, okay, we know who you are and we think we know where you live, but you gotta tell us a certified tax identification number. You have to certify your social security number to us. And the problem with that, and this is a problem that other jurisdictions, our CASP and other jurisdictions will have as well, is getting those customers to actually do it. What this will probably mean is a pop-up window saying, hi, welcome back to the platform. Please give us your social security number. And then the user clicks the X and gets rid of that pop-up window. I'll do that later if I ever do it. Eventually, the entity has to do tax reporting on customers who don't do that, or not tax reporting, tax withholding on customers who don't do that. But what the Treasury Department has said in the United States is, we get it. We know that takes some time to get your existing customers to give you this information. So we're giving you, considering these came out in September, 18 months at least, sort of, to do this, so that you don't have to do it by this coming January 1st, 2025. If someone doesn't certify, if a customer of yours doesn't certify to their social security number by January 1st of this coming year, you don't yet have to do tax reporting on that person. So that's a big kind of sigh of relief for brokers in the United States. And finally, real quick, what goes on a Form 1099 DA in the United States? Obviously, name, address, and TIN. It's similar to what's in CARF jurisdictions: digital asset name, quantity, sale date and time. The time is something they were going to require, but in final regulations said, no, you don't have to give us the time. We get it. That's a little too detail oriented. Gross proceeds at first, transaction ID, just like time, transaction ID and wallet addresses were something they had proposed collecting, but pulled back on in final regulations saying, okay, don't put that on the form, but do keep that information for 7 years if we need it. And finally, is the sale for cash, cards, payment cards, services, or property. And then information that has to be collected, transfer date, collected eventually, transfer date and time, transfer transactions, transfer from wallet addresses, and transfer quantity. Coming down the pipe in the future, 1099s will, well, not in 1099s, but on forms known as transfer statements, will have to be provided to the Internal Revenue Service if a broker transfers in assets for a customer to an entity that it knows is not a reporting broker, like a cold wallet or something like that. That's the information that we can get into for now. We can talk much more about this. Please reach out to us if you want to. Max's email is right there. So is mine. It's very simple, max@taxbit.com or john@taxbit.com. And we are more than happy to take your questions and help you with any questions you may have, including right now. So I guess, Diana, I'll hand it back to you.
Thank you so much, John, for your presentation. And thank you, Max. What a wonderful surprise to have you join us to jump in and share your insights as well. We really appreciate this presentation about really the importance of tax reporting updates and the significance of CARF as the crypto asset reporting framework. Again, I'm Diana, Head of Research and Sustainability, and we're going to take questions. The first of which I wanted to start. We mentioned all the benefits and all the, but what can you say would be the roadblocks in implementation, and what are the best ways to address them at this point?
The biggest roadblock, and obviously Max might chime in here too, but it is a technological lift, and we can help you with that. Gathering information, two things. And the first, we can help you with both, but the first is oftentimes, especially custodial brokers, custodial CASPs, have the information they need to report, but it's in disparate places. Some information might be in a marketing database, some information might be in some other database. And what you need to do is bring all that information together so that you can collect it in one homogenized way going forward, so that tax reporting becomes more routine, easier to do than it is at first. And that's something we can help you with. The second thing, again, that you need to get your heads around are saying to your existing customers, it's going to take some time because it requires effort on their part. It's going to require their willingness to give you this information at the outset. Okay, again, you have to say to them, I know who you are. Please update your name if it's wrong. Update your email address, but update your address. And we need your tax identification number. This is something that obviously people on this call will understand is not something customers are eager to give, but it's generally something you're going to have to get. So take this time to start collecting that information. And this is something we can help you do as well if you have questions on that. Max, do you have anything to add to that?
Yes, I think the issue of the self-certification, the self-certification of pre-existing customers is one of the biggest pain points we see as of today, because especially, I mean, it's one point to implement that in the United States, but it's another point to implement that on a global scale, since there will be different KYC requirements maybe across jurisdictions. And as we see right now with the implementation of the ACA, self-certification of customers can be up like anywhere between 4 and 10 euros per person. So very, very expensive on the KYC and certification part. So this is something that we are trying to work on the level of the OECD to make this very streamlined. And this is where we at Taxbit can really help our customers as well in this process of onboarding clients and really using getting prepared for the crypto asset reporting framework, as John mentioned as well.
Yes, so helpful. So moving on to a next audience question. Can you talk through the ongoing discussion of crypto as a security, commodity, or currency, or what it is from a tax point of view? You're laughing, so you probably have a lot to say.
I am not a securities lawyer. I'm never going to be a securities lawyer. And so, and Taxbit is quite neutral on this topic. It's a topic that dominates the policy world in this area in the United States, and we generally stay out of it. So I'm going to try to stay out of it here too. What I can say is that when it comes to, if there's one thing that I think is worth noting from a tax perspective, which is when you see the word security in the US tax code in Title 26, it generally does not have the same definition, generally, as the word security in our securities laws. Generally, in the US tax code, and don't write this down and give it to a client, this is not legal advice, but securities is synonymous with the word bond in the US tax code. So when they say stocks and securities, what they're sometimes saying is stocks and bonds, generally. And so that applies to things like wash sales, which is going to be a hot topic in 2025 for tax purposes. Can you accrue tax benefit by engaging in a wash sale? At the moment you can, because for tax purposes, digital assets are generally not securities. That's not to say they're not securities for securities laws purposes, but for tax purposes, they're generally not in the United States. So that's a hiccup that you might see and have questions about.
And maybe looking on a more international scale, there is no uniform security law globally, right? Even within the European Union, every member state and jurisdiction has different security laws. So the question is what really falls in Europe under MiFID, what would be falling under MiCA, because you have to, for financial instruments or for crypto assets. And then again, the crypto asset reporting framework in 1099-DA ultimately are really just reporting requirements. They don't cover taxation as per se, right? So I think this is also very, very important to highlight, because there were, like, especially in the
Max, we lost you for a little bit.
Well, I would encourage everybody to reach back out to Max and ask him to finish up on this question, because you will love talking to Max.
Yep. Let's keep going to the next question, and if we get Max back, we'll have him finish his point. Next question is, do you think the tax authorities have the staff and are ready for crypto reporting requirements? And what about enforcement?
In the United, I can speak to the United States. I will always say that the U.S. Treasury are staffed by the best tax professionals in the United States, and the IRS as well. And so, yes, I do think they'll be up and ready. There have been some reports talking about, and your audience may have seen this, some reports by an entity called TIGDA saying the criminal side, the criminal investigators in the IRS have done more in this area than the civil side has. I attribute that mostly to generally a lack of tax reporting. The IRS has been active in this space by summoning exchanges over the last 5, 6, perhaps more years than that. But generally, there's not that much they can do until the tax reporting goes into effect. And so, yes, I think they'll be ready.
We still have some time too, so good
Yeah.
point, good point. What about talking about and addressing the difference in tax requirements at a global level, and how could this potentially lead to tax arbitrage?
I think that's the point of CARF, to kind of minimize those opportunities for it. I have spent a career litigating for the United States government tax shelters, which is basically, tax shelters come in broad categories, and one of the categories I put them in is basically tax arbitrage, treating disparities from one jurisdiction to another jurisdiction and playing those off of one another so you can get the maximum tax benefit from them. Tax reporting really, it's about risk assessment, as our slide showed, but the heart of it is really about, I would say, treating jurisdictions similarly in terms of the information that they get, so that there's as little possibility for that out there. It's a hard question to answer, because you're essentially asking, what are jurisdictions going to do in the future? I don't know, and no one can say that for sure. But one thing that's kind of clear is that all roads are kind of converging on the same place, which is that there are going to be fewer and fewer places that don't require tax reporting in some way, shape, or form, even if it's requiring someone in a jurisdiction that just doesn't require tax reporting to have to do tax reporting on someone in another jurisdiction. And so the chances of entities not having to know a customer's social security number or tax identification number are going to be smaller and smaller in the future. Max, you're back. Do you have anything to add to that?
Yes.
Unfortunately, my internet connection got
Yes,
cut off.
but you're
So
back.
yes, what was the question?
Talking through the difference in tax requirements globally, and could this lead to potential tax arbitrage?
I think that is what's happening as of now, like globally anyways, right? There's always, like, even in the European Union, there's no uniform single regime for taxation across jurisdictions. And what the crypto asset reporting framework does, it aligns information reporting requirements for service providers on crypto-related activities of their users. But it does not solve the issue of regulatory arbitrage in terms of taxation, because still there will be a run to jurisdictions with lower tax rates, like we have seen in traditional finance as well. So the question is really, is that the goal of the crypto asset reporting framework to even tackle? No, it isn't. For the crypto asset reporting framework, it's just there to really counter the issue of the lack of tax transparency. So just it's really about governments or tax administrations knowing about the holdings of their individual taxpayers. But it's ultimately not about solving an issue of like creating a uniform taxation regime on crypto assets or anything blockchain related. Because I can say that with 100% certainty, this is not going to happen within the near future, not even within the European Union.
Yeah. And also, because we lost Max and you were in the middle of saying a point, I want to give you a chance to finish your point before we move to the next question.
I was just talking about securities in Europe and how, like, there's a big debate also among European Union member states on how to qualify certain blockchain-based assets, right? Because it's also important in the context of what should apply, like the Markets and Crypto Asset Regulation, in short MiCA, or should it be MiFID that is applied to those assets? So in terms of security laws, we don't even have a uniform consensus in Europe, and we don't have something like the Howey test. So it's very tough to give you a definitive answer on that.
Right. Well, moving on to the point of view of actual businesses, this is going to be our last question. How does the addition of tax reporting requirements impact actual businesses? What new considerations does it raise, new issues, and what do they need to do to prepare for it?
I would say I would answer that by answering with a discussion I have with policymakers in Washington, D.C., which is that, and I sort of alluded to it in my last conversation, which is business models are going to more and more have to accept one that knows who their customers are, even if it's not just for tax purposes. In the United States Senate for the past year, there's been a big debate. Should DeFi have to know who their customers are for AML purposes? And it's a debate that's not settled under the framework, under an AML perspective. But what I point out to them is, this question is being settled for tax purposes. For tax purposes, those entities are more than likely in the coming years going to have to know who their customers are. Is the information they're going to get for AML purposes different from tax purposes? Maybe. But you're still crossing that threshold of saying to your customers, okay, who are you and where do you live? And what's your tax identification number? That is something that, and we're not saying it should happen that way. We're saying it's probably going to happen that way. That's my view of the future in terms of business models.
I agree with that. I think that through taxation information reporting requirements, it will be a KYC plus that is being introduced. So basically, the taxation information reporting requirements mainly build on the AML reporting requirements. So OECD is always looking at the standards of the Financial Action Task Force also for the reporting of taxation related matters. After all, for the business model, it's very important for the service providers to prepare for these requirements as soon as possible. I mean, like under DAC8, like on the contrary to what John explained before with the United States, for example, in the European Union, under the transposition law of the crypto asset reporting framework, the so-called DAC8, we have the requirement for service providers to freeze accounts from performing exchange transactions if they don't submit valid self-certifications. So it will be very, very important for the business models for operating service providers to do the KYC parts like in advance before they actually enable transactions. And then also it's just very, very important to have the right mechanisms in place to track transactions of the users, right? But this is something that they kind of would need to do today anyways already, but what they will be required to do as soon as the information reporting requirements kick in.
Wonderful. Well, we are out of time, unfortunately. So I will close it and say thank you so much to John and thank you so much to Max. I didn't get a chance to introduce you, but Dr. Max Bernt is Taxbit's Managing Director for Europe. And we're all glad that he made it to his final destination. Better late than never, and you made it safely and fine, and you joined us. It was a great surprise and great addition.
And thank you very much for hosting me. And maybe just to highlight this, I just published also an article in the new international journal from GBBC that is coming up next week on the crypto asset reporting framework and its implications. So who's interested, I wanted to highlight this as well.
Keep an eye on it because we are definitely following this issue. It's very important. So again, really appreciate you joining us today for this thoughtful and engaging presentation and Q&A on crypto tax reporting and how organizations are and should embrace it in the future. We look forward to learning more about Taxbit's progress, and in the meantime, we'll read your article. A recording of this presentation will be circulated to all those who registered, and it will also be shared publicly on GBBC's YouTube channels, where we tend to get a lot of views after the fact. Thank you to all the audience and have a wonderful day.
Thank you very much.
Thank you very much.